Last week, we started the market update with tough week for interest rates. Unfortunately, this week, we're starting with tougher week for interest rates. So today, the CPI came in hotter than expected, and this marks 4 consecutive months that CPI has came in above expectation levels. And unfortunately, expectation levels were actually high. So the fact that they came in higher than these levels are painful for interest rates. So CPI came in at a 0.4% month over month, bringing up the year over year CPI to 3.5. And the reason for the pain in interest rate is essentially the annualized rate. When you look at both January, February, and March CPI, we had a 0.3 print, 0.4, and 0.4. That adds up to 1.1. Now, if you annualize this out for the rest of the year, that equates to above a 4% CPI, which is significantly above that Fed target of 2%. So going into this print, there was hope that, hey, January and February prints were basically nothing. It wasn't going to do anything. And the reason for that hope was new year, new price. That normally, hey, in January, the first day of the calendar year, companies increase their prices, leading to a short-term inflation rally, right? And hey, the noise would eventually be canceled out. So that's why March was such a pivotal day, because January, February came in hot, and the Fed kind of acknowledged, hey, we were expecting them to come in hot. But now we're kind of looking at, hey, when does this expectation of hot start to slow down? When does it start to get back to those 0.2 or 0.1% prints? The reality of getting to that Fed percent target requires us to get to those numbers. And that's where March became a pivotal one. And March coming in hotter than expectation hurts us, right? And it caused the US 10-year Treasury to move from about 4.3 to 4.6, causing interest rates to lose about 0.25% in just one day. So it hurts, but let's look at the bright side, right? We want to look at, hey, when will this end? So last week, we also mentioned that the Fed was projecting that the first interest rate cut would be in June, and that this CPI print would determine if that first rate cut. We said that we didn't believe the first rate cut would be in June, and it would get pushed back, and it did follow through. Now the first rate cut is projected to be in September. We're still seeing a lot of countering arguments. Today, even after the CPI print came out, Goldman Sachs came out and said, hey, they still believe that the first rate cut is going to be in July. So even after today's print, there's a lot of banks, there's a lot of hedge funds coming out saying, look, ignore the noise. March is just kind of following that January and February noise of new year, new price. And we will start to see inflation start to slow down here in Q2. And we can see that, hey, in April, we will likely see a better print. And remember, inflation on the year-over-year perspective is just adding up month over month. So last April, we had a poor inflation print of 0.4%. Technically, March was actually slower than February. February was like 0.42-ish, and then March was 0.38. So we are starting to see slowingness of inflation. And we can add that into with GDP, right? GDP has also slowed down. Q3 was 4.9%. Q4 was about 3.5%. And now Q1 of this year was 2.5%. So we're starting to see signs of the slowing economy. Starting to see wage growth slow down. And when wage growth slows down, and we're seeing that from the labor market, that usually means people don't have as much money to spend. So all of this should finally start to play into the data here in Q2, Q3. So when this April report comes out, we can expect that the 0.4 in April of last year should be replaced with a better number. And then we'll finally see that stall out number that, hey, inflation's risen 3 consecutive months, stalls out, give the Fed the ammunition that, hey, the first quarter was just kind of some noise. So stay tuned that in April, or in May, reading that April report, it should be good. The problem with that is it's April 10th right now. And there's 3 major days that can really shift interest rates. And again, these are major days. There's other items that can shift interest rates, but these are the 3 most important: labor market, data reports, CPI, and Fed meetings. The problem is we don't have another one of those reports for basically 3 weeks. The Fed meeting's May 1st. Labor is always the first week of May, and then CPI will probably come out around May 10th. So stay tuned. That, I believe, in May, we'll kind of finally start to see this cool down. We won't have another quarter one. We won't have another major shift. But yeah, right now, if you're shopping, do check in with your loan officer. Interest rates could have went up slightly, but it's not necessarily a poor time to buy, because we hopefully are nearing in on that top, and we can start to see the lower interest rates in Q3 and in Q4 once the noise starts to filter out of the data.